Bank of America is announcing earnings before market open on July 18th. You can see that the earnings per share estimate is currently nearly 85 cents, which is well above last year's Q2 actual of 73 cents. This is despite the fact that for the most part, the banking industry has been under heavy scrutiny this year due to the amount of unrealized losses on the books from the bond portfolios. For this institution in particular, in Bank of America, they have a large exposure to potential bond losses via the unrealized gains portion of the portfolio, or unrealized losses in this instance. If we go to the fundamentals here on TD Ameritrade's website and we come over to the balance sheet, you're going to see some of the different assets that the institution has. The main item that we're going to be looking at is the total investable securities. Now, these values are displayed in millions, and you can see that as of the Q2 earnings that they had last year, they had total investable securities of $932 million. This is largely due to the fact that the interest rate environment in 2021 and 2022 was very low, so a lot of institutions were putting a ton of money into these different types of securities so that they have the capability to get some form of yield instead of putting them into mortgages at 2 and 3%. At this point in time, you can see that the institutions have begun switching what they want to put their money into, as they can get quite a bit more in the market today versus what they're paying their depositors. If we come over to the income statement, you can see that play out in real time. So in Q1 of this year, you can see that the interest and fees on loans in a single quarter was north of 13 billion compared to it was during Q2 2022 of 8.2 billion. This is happening despite the fact that if we come back to this screen, you can see on a loan by loan basis from a deposit base, this is on the cash and due from bank side, so what they're holding, this has increased dramatically. However, the total loans is only marginally higher. So this means that institutions, or rather individuals and other institutions, are putting a lot more money in the bank. However, for the total gross loans, it's only up by a relatively small amount. This is especially important to note that this is happening at the same time that we are seeing a large increase in interest rates, which means that we would expect loan growth to slow. So this overall amount is still net positive. This is something that we're going to be looking at here in the Q2 earnings that comes out. But we can also see that the loan loss allowance, which is the amount that an institution is holding back in the event that loans go bad, has been relatively stagnant over the past 3 quarters. Going forward, it'll be interesting to see if this increases. So what we're going to be looking at for earnings on this quarter is the interest income going to continue to go up? Because overall, all interest income is up nearly 100% from Q1 2023 to Q2 2022. I would expect that to continue to go up. However, total interest expense has gone up incredibly quickly from the 2.5 billion that happened last year to the 14.2 billion as of this point in time. Overall, though, the overall loan loss provision expense has, despite going up, has had overall net income be 13.5 billion. So that'll be the number we're watching for on an ongoing basis. The other item we're going to be looking up is the non-interest expense going to continue going up at the same rate, in particular the other expense line item. Labor and related expenses is expected to continue to increase, but we want to watch that other expense because in the event that a loan is charged off or it goes into default, the bank will have to pay for upkeep of properties, it'll have to pay selling costs, and in the event that is not hitting their actual loss column, it would hit here. So we're going to watch this to see if this is going up on an ongoing basis. So with interest income flying high, the interest expense is something that should also go up, especially as banks are trying to stem that deposit outflow. So that's something that we will continue to watch on an ongoing basis. At this point in time, looking at where the stock is today, on a year-to-date basis, you can see that we are well off the highs from that drop that we saw in late February, early March, from when we saw the Silicon Valley Bank and subsequently Signature Bank, as well as First Republic drops. You can see that the company, despite continuing to do well, is going to continue to be under pressure, and I think the banking space in general will continue to do so. Despite that, if we look at that on a 5-year chart, the company is basically where it was in 2019. So the question here is this dividend income going to be continue to be worth it, or is there potential for the banking stocks in the banking sector to get back to similar levels of where it was in late 2019, early 2020, or even what we saw in 2021 and early 2022? At this point in time, with the stock at 29 or just north of $29, I don't see a lot of upside potential due to the fact that there is going to be heavy regulatory emphasis for stress testing going into the latter half of this calendar year, especially on the liquidity side, meaning how much money does a bank have on hand in the events that deposits run out of the house. Just this past week, all the financial institutions in the United States above $100 billion in total assets did pass their DFAST stress test, which is an annual exercise where the Federal Reserve is testing the capability of institutions to withstand credit risk and some versions of liquidity risk. But overall, it'll be interesting to see where the company does in terms of earnings for Q2. Again, that's going to be coming up here momentarily. Overall, Bank of America is sitting just north of $230 billion in total market capitalization. They have a PE ratio, which is on the historical low side of 8.65, and the annual dividend here is about 3%. So this is one to watch. They are one of the largest financial institutions in the United States, and they are going to be announcing earnings alongside the likes of JP Morgan, Citigroup, and Wells Fargo to round out the big four. So it'll be one to watch and one I'm super interested to follow along with. So if you find this content helpful, please leave a like and subscribe, and let me know in the comment section down below if you are going to be looking at Bank of America. Thanks. Talk to you later.